The US-Japan joint intervention to defend yen is already fading, and now Japan is left with two options: sit back and watch its currency keep bleeding value, or raise interest rate to pull Japanese capital back home from foreign market. Whichever one Tokyo picks is gonna hit your pocket directly, and here's the main part mainstream media won't say out loud. Option 2 doesn't just strengthen yen, it's donate carry trade. That's not the lever Tokyo gets to pull gently. Once they tighten hard enough, the market unwinds it for them on its own schedule. That's why they have been stalling and tried third option. On Thursday 31st of July, Japan went in alone. Bank of Japan data suggests they have burned as much as 59 billion buying in a single session. Friday, Washington joined. New York sold euros out of US reserve and bought yen on behalf of Japanese treasuries, roughly 5 to 10 billion dollars, executed through Goldman Sachs and Morgan Stanley. A small money next to Japan number, but that wasn't the point. The point was the signal. This was the first time United States had bought yen alongside Tokyo since 1998, and it worked. For a day, USD JPY pair went nearly 164 down to 157, but it started leaking. The yen gave up roughly a third of that move and drifted back to 159. Why? Because American and Japanese investors already knew that this wouldn't hold. Intervention doesn't change the rate differential. It doesn't touch the reason people are shorting yen in the first place. It just put a floor under the market for a few sessions, but the market knows that floor is temporary. Traders called it exactly what it was: buying time. So they treated a strong yen as a gift, and they sold into a rally and rotated straight back to foreign assets. As long as Japan investor can borrow at 1% and earn nearly 4 on a US treasury, the carry trade doesn't stop. Bank of Japan policy rate 1%. Federal fund rate 3.5% to 3.75%. That spread is the reason of the carry trade. Nothing will save yen while that gap stay wide, which means the Tokyo has to keep increasing rate. But that comes with brutal consequences, and neither Japan or America is ready for them. The moment when Bank of Japan will decide to increase interest rate high enough, then the investor who had funded their account with a cheap yen will start liquidating whatever they are holding, whether they are holding crypto, because it is the fastest to exit. It trades 24 into 7, no settlement delay. It will be followed by equities and bond market. This brings slower flow. Japanese capital starts selling their foreign assets, converting dollar to yen and going back to home again. The yen is strengthened, but Japan's own equity market falls, its debt burden rises, and its economy slows down. Tokyo and Washington both understand this, and that's the reason exactly why they are buying time instead of rising rate right now. But buying time is just isn't working now. But Japan can't afford to do nothing. Either this is a country that import almost all of its energy, nearly 100% of its crude oil, and more than half of its food. A weaker yen make each barrel and each shipment more expensive to import in their country, and that imported inflation flowing straight into the household budget, and it's already showing up politically. Japan Prime Minister approval rating fell from 69% to 57 in a single month. Dissatisfaction with how her government is handling the cost of living jumped from 59% to 71%. Therefore, to cool that inflation, the Bank of Japan ultimately has to increase interest rate. So Tokyo may not be waiting much longer. The next Bank of Japan meeting is in September 17th and 18th, where we might see a serious rate hike. But here is the complication. For rate hike to actually work, Japan has to narrow interest rate gap between US and Japan. That a Japan investor has to earn more at home than abroad. But the Fed isn't cutting rate. At the July meeting, 3 FOMC members voted in favor of rate hikes. So the gap stays wide, and Japan has to increase the rate far more aggressively to close it. But higher policy rate means Japan government has to issue new government bonds at a higher yield to attract buyer. Japan's debt to GDP ratio is already highest in developed world, and Bank of Japan itself owns close to half of the government bonds, and they are trying actively to shrink their position. And once the Japan government bond finally pay a decent return, the big money start moving pension fund, life insurance to Japanese government bond, because for 30 years they had no choice but to take risks because the domestic bond paying nothing. But now they have a choice and they take it. But it drains their equity market. Export weaken as yen strengthen. Growth slows of country, followed by job losses. So whether Tokyo hikes rate or not, Japan is walking into serious contraction. and it does not only stay in Japan. There are two wires running from Tokyo to rest of world and both are live. Wire 1. Japan is the largest foreign holder of US government debt on the planet, about $1.2 trillion. For 30 years, Japanese insurance companies and pension funds bought US Treasury because Japanese bonds paid nothing. But now Japan government bonds pay something. The moment domestic bond win that comparison, the sign the biggest buyer of the American debt start working out of US. Therefore, American bond will rise, mortgage rates will rise, and the bond high yield in the US could attract investors and liquidity could follow, crashing crypto and stock market to US treasuries. Wire second, and it's the trap. If the Fed hike rates and the three FOMC members just voted for exactly that in July, and if it happened, the US and Japan interest rate difference will get wider, and wider difference in interest rate means the carry trade pays better in America, which means more Japanese yen coming to US, which means Japan has to increase rate even harder to catch up. But US rate hike will grow an even bigger debt burden on America because borrowing cost for America has become expensive due to rate hike, and this might slow down American whole economy. Yen will keep losing its value and healthy competition of trade in a global market will break, and many countries have to sell their product by devaluing it, which means it could lead to the global crisis. So most of investors now think this can no longer be avoided, only delayed. Every intervention is just for buying more time at the cost of foreign reserve. Whether it becomes genius global crisis depend on one thing: how disorderly the carry trade is going to unwind. But if Japan rises rates slowly and tell market well in advance, the world can handle it. Traders will get time to unwind, and there will be a buyer on the other side of every sell. But if it happens fast, everybody heading for same exit at once and nobody is there to catch it, then it can lead to crash. And we have already saw this at the end of July 2024. Bank of Japan raised rate to 0.25%. 3 days later, a weak US job report landed. The carry trade unwinds all at once. Everybody running for the same exit. Nobody here to catch it. The nickel fell 12% in one day. It was worst session since 1987. So now ask yourself what real interest rate hike is going to do to the global market. So be prepared for what's coming because Japan and US are just buying time and nobody knows whether they can stop it or not. If you think there is a better option Japan and US could take here, drop it in a comment. I will see you tomorrow. Thank you for watching.